Have you ever looked at one of those blinking stock charts and felt like you were trying to read some ancient secret code? Yeah, you're definitely not alone. So today, we're going to demystify the entire world of financial trading. We're going to give you the fundamental building blocks you need to understand it, all in the next few minutes.
Okay, so here's our game plan. First, we'll nail down what trading actually is. Then, we'll take a look at the massive 24-hour global market. After that, we're going to learn the lingo, the essential language every trader knows. Then we'll get into the nitty-gritty, the mechanics of a trade, and we'll wrap it all up by exploring the different trading styles so you can see what might just fit your personality. Let's jump right in.
All right, first up, what is trading, really? I mean, beyond what you see in the movies with all the flashing numbers and shouting, we're going to break down the core idea and look at the four main arenas where all the action really happens.
You know, at its heart, the idea of trading is incredibly simple. It's all about making an educated guess, a speculation, on which way an asset's price is headed. The classic goal? Buy low, sell high. Simple. But here's a cool thing. You can also do the exact opposite. You can sell something you expect to go down in price and then buy it back cheaper later for a profit.
And you've got plenty of options for where you want to trade. You could get into stocks, which are basically tiny ownership pieces of a company, or Forex, which is the massive world of currencies. You could trade precious metals like gold and silver, or even physical commodities like crude oil. Each one is its own unique universe with its own rules.
So now we know what you can trade, but what about when? See, this isn't your grandfather's stock market that rings a bell and closes down at 4 p.m. We're talking about a global arena that literally never sleeps.
And the scale of this thing, it's just mind-boggling. To put it in perspective for you, the Forex market, just the currency market, trades over $5 trillion every single day. That means the amount of activity and opportunity happening at any given moment is absolutely massive. So how is that even possible? Well, it's because the market is really just a network of big international sessions that overlap. As Asia is winding down for the day, London is just firing up. And as London starts to close, New York takes the baton. It creates this continuous 24-hour cycle that runs 5 days a week.
Okay, to even think about participating in this global game, you've got to speak the language. And believe me, the market has its own dialect, its own unique terms and visual cues that tell you exactly what's going on.
If you only remember one thing, remember this. The market is nothing more than a giant tug-of-war. On one side, you have the buyers, who are pulling with all their might to make the price go up. And on the other side, you have the sellers, pulling just as hard to bring the price down. That's it. That's the whole game.
And traders have these great simple names for these movements. When the market is heading up, they call it bullish. Why? Because a bull attacks by thrusting its horns upwards. And when the market is going down, it's bearish, because a bear attacks by swiping its claws downwards. See? Super simple, but totally effective.
Now, within these big trends, you'll start to see these key levels form. One is called support, and you can think of it like a price floor, where a falling price often hits, pauses, and bounces back up. The other is called resistance, and it's the opposite. It's like a price ceiling, where a rising price tends to stall and turn back down.
So, how do traders see all of this action? Well, the main way is with something called a candlestick chart. And what's so cool is that every single candle on that chart tells a complete story of the battle between the buyers and sellers over a specific period of time, whether that's just 1 minute or an entire day.
So how do you read one of these things? It's actually way easier than it looks. Every single candle gives you 4 key pieces of information: the price where things opened, the absolute high and low the price hit, and finally where the price closed when the time was up. That's the whole story, right there in one little shape. All right, so we've got the lingo down. We know what we're looking at. Now let's get into the real mechanics, the practical terms that define the size, the value, and the risk of any trade you might make. In the world of Forex trading, those tiny little price movements are measured in something called pips. The easiest way to think of it is like inches on a ruler. It's just a tiny, standard unit that lets traders count their profits or losses. But the big question is, how much money is 1 pip actually worth? Well, that brings us right to our next point.
See, the value of a pip all comes down to your lot size. And lot size is just a fancy term for how big your trade is. It's really straightforward. If you trade a bigger lot size, each pip movement is worth more money. If you trade a smaller lot size, each pip is worth less. The key thing here is that you control the stakes.
And finally, there's leverage. This is a big one. Leverage is basically like getting a short-term loan from your broker. It lets you control a much larger position in the market with only a small amount of your own capital. But you have to be careful, because it is a true double-edged sword. It can amplify your profits like crazy, but it will amplify your losses just as fast. It absolutely demands respect.
Okay, so you've got all these concepts, all these tools. How do people actually put it all together and trade? Well, let's look at the 4 main trading styles, and you'll see they're pretty much all defined by one thing: how long a trader holds onto their trade.
This chart lays out the whole spectrum beautifully. On one extreme, you have the scalpers. These guys are in and out of a trade in just seconds or minutes, trying to grab tiny profits. Then you've got day traders, who open and close all their trades within the same day. Swing traders are more patient, holding trades for a few days or even weeks. And finally, you've got position traders, who are playing the super long game, holding for months or sometimes even years. There's a style for every personality type.
And that brings us to a really powerful final thought from the legendary trader George Soros. Because at the end of the day, successful trading isn't just about strategy or being a genius chart reader. It's about psychology. It's about discipline. It's not about being right all the time. It's about how you manage being wrong.